So financial prosperity is something that each and every one of us have a deep desire to experience on some level or another. For some, that means financial stability. For some, that means outright financial freedom. And as we already know, one of the most effective ways to reach this goal is through proper and effective, sustained investing. We already know that a lot of the riches that are made are through businesses and the investment of other businesses and business opportunities. This includes stocks and also bond opportunities. And so with this being the case, many of us charge into these opportunities headfirst without doing a lot of due diligence and the understanding of fundamentals of what stock investing and bond investing are and what type of investor you might be. Because many times we're marketed these opportunities to join different brokerages or jump into a certain index fund or ETF. There's not a lot of research done on what they even are and where you might fit best to have the best results. I'm going to help you uncover that through fundamental breakdown of what stocks are, what bonds are, and where you might fit in investing in either or both in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrow capacity, proper use of life insurance, and the ownership of real estate. Like this video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So what are stocks? Stocks are going to be shares of ownership of a company. It's going to be fractional shares based on the total number of shares that company has issued. So that means if you own a share of this company, said company, that you're typically going to have voting rights in most cases, and you're going to have residual claims to the growth of that company and any dividends. So capital gains and dividends. So with that being said, you want to look at this as an opportunity in most cases to get ownership and some say so in a company and also earnings from that company's growth and expansion. Alongside of that situation, you also have to keep in mind that you're going to be riding a roller coaster with that company if you decide to stay invested, if they're not doing well, or whatever risk that company may be subject to. So what are bonds? Bonds are actually going to be loans. Governments and corporations are going to actually issue bonds out, allowing investors to provide them capital. They're going to pay you back that capital at a fixed specific time that's agreed upon, and then also pay you out interest on that capital over a period of time as well. There's a certain yield or earning that you're getting on that investment. So we're talking about two different beasts when we talk about stocks and when we talk about bonds, right? Clearly, there's a distinction here. With stocks, you actually own part of a company. With bonds, you're simply issuing a loan and usually getting some type of fixed or agreed upon return interest payments over an agreed amount of specific time. So you're playing lender on one side versus being an owner on the other. Major difference. And this is where you need to start drawing a line on what side of the equation you want to be on. So what are some of the benefits, for instance, of investing in bonds versus investing in stocks? Well, a couple benefits is going to be bonds are typically a little lower in volatility. So that means that they have, on average, less fluctuation in their value and your earnings. Usually you have high liquidity when it comes to bonds. Not always the case, but typically speaking, your money is going to be more accessible to you. Legal protections. This is a big one. So when you invest in stocks, if that company goes belly up and you're invested, in a lot of cases, your stock can just turn out to be worthless. There's no guarantees or buffers on you getting any kind of payout on that company when that company goes belly up or ends up, useless over time, or worthless rather over time. When you start talking about bonds, in most countries, bonds actually come with some level of legal protection. In some level or another, it may not be the highest ranking of lien, if you will, but at the end of the day, you are on a list of lien holders that are intended to be paid out based on whatever money that company or government is going to have as they're dying out. So that means whatever asset or network they have as they go belly up, they have to pay out to certain lien holders, if you will. Not really lien holders. I should probably clarify that because I want to be clear. But you are basically in a debtor that they have a certain legal obligation to pay out on. And depending on which, layer you fall in as a debtor, that government or corporation, based on whatever assets they have left liquidated to pay out to these debtors, they have to pay them out in a certain order. And based on where you are, there's a chance you can get some of your money back. I do want to retract the lien holder comment because it's not really a lien, but you're a debtor that is in a line, in a certain order, a hierarchy of getting paid back if that company or that government collapses. So some other benefits are going to be you have various term structures. And so this is going to be valuable because now you get to invest your money, or a matter of fact, lend your money out, better yet than invest. You get to lend your money out. And usually there's going to be several different term options available depending on that bond. And this allows you to better control when you get your money back versus investing in stocks. You're kind of riding a wave and just hoping to catch it at its highest point and cash out on it at some point in time. But it's a totally different ride on average than bonds. So on the risk side, when it comes to bonds, you are subject to interest rate risk. And right now in this economy, we're experiencing that firsthand because interest rates, the federal funds rate in particular, are changing, they're shifting. So that means that certain bonds are becoming less valuable and certain bonds are becoming more valuable. And these shifts happen fast, as we've seen during this pandemic timeframe and coming out of the pandemic, where interest rates have been lowered and have raised in very short windows of time at really high and low levels. So that means that you've seen major shifts in bonds. The economy is also another factor at play when it comes to the interest rates, which affects bonds as well. The economy is doing well, interest rates may go in one direction. The economy is doing terrible, the interest rates are going to go in another direction. All of this has an impact on your bond investments that you may be in. So you also have prepayment risk. You may be asking yourself, what is a prepayment risk on a bond? Remember, you're a lender in this scenario. So what that means is you're looking to get your interest payments over time. And the longer that bond is in place for, the whatever that specific payout term where they pay you the face amount at some point, the further out that is on average, the more interest payments you're collecting, right? That makes sense. So that basically means that if that government or corporation pays you out sooner, then you are not getting back as much earnings on your money as you initially may have intended. So that is technically a form of risk. Credit risk. This is another big one. You're a lender now. So that basically means the government or the corporation that you're lending your money out to could technically default. And those of you who may be new to investing or newer to investing may not think about it per se, but governments and corporations actually have credit ratings just like individuals do. And based on that government or that company's credit rating can help determine their value. And it also is something that you need to pay attention to for the risk of default. The riskier that government or that corporation is based on their credit rating, just like an individual, that means the higher the return. The higher the risk, the higher the return. But it is possible for a government or a corporation to default on that debt. Again, that's where it comes back into play that you have some legal protection in most countries. If you're in Western countries in particular, in most cases, you're likely on the list of debtors that have to be paid out based on whatever assets are left for that company or that government to pay out. Reinvestment risk and liquidity risk are also factors that you have to consider when it comes to bonds. So these are the fundamentals between stocks and bonds that you need to understand. And you need to have these fundamental understandings if you're relatively new to investing, or if you're already investing and just never really thought about what the difference of these two different investment opportunities are, because this will help you understand where to put your money. You know, there are opportunities out there when the stock market is red hot and there's a great opportunity, or particular companies in the stock market are red hot, and owning those companies could be a great investment. There are opportunities and there's certain economic circumstances that can make bonds really attractive for better stability, fixed returns, predictable payout periods. These, and sometimes even inflation protection. These are the different things that you need to be considering and understanding what they are and their fundamentals helps you to actually understand where to be as the economic cycle shifts and money's moving from one area to the next, chasing the best return or the minimizing the risk. So now that you have a better understanding, whether you're new to investing or you're already investing, but you learned something in this video, you can maybe go back and rebalance your portfolio out. Maybe you're saying, oh, well, I'm in a 60-40 stock to bond ratio. And based on the economic circumstances, maybe I need to increase my bond holdings and cut back on my stock holdings because the stock market's in the red, but certain bonds are doing really well right now. We're going to talk about different analysis that you could be doing that you don't need to be a rocket scientist to do to better understand how to manage your own portfolio, or at least better follow financial professionals that you're hiring to help manage your portfolio for you. You want to have at least a fundamental understanding of where your money is going if you want to be a successful investor in this economy. This is JP from Blueprint for Prosperity. I'm checking out. Thank y'all for tuning in as always. I know this was informative for you. I want you guys to comment down below if you've learned something in this video and this is gonna help give you the encouragement or some direction on starting investing. I want you to comment down below if you're already investing and tell me what you think about what routes you're taking. What are your stock holdings? What are your bond holdings and why? Drop it in the comments below. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.